Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. It's Wednesday. Yesterday, we talked a bit about the sell-off in the market yesterday morning and that the NASDAQ might actually be a little bit better place to be. Now, I've been talking about this the last couple of days, and admittedly, I was a little bit early getting into some of my positions that I added to. But again, what we saw yesterday in particular was the NASDAQ opened down sharply yesterday morning, actually recovered all day yesterday. And again, we continue to narrow that gap between our money flow indicator and money flows, and we're getting very close to getting that positive turn. And importantly, we saw a turn up in money flows yesterday. This was slightly negative yesterday morning, actually turned positive in the afternoon. So we actually had a strong spate of money flows coming into the NASDAQ yesterday. So that was encouraging as we start to see some money flowing back into the NASDAQ. The premise is that over the next few weeks, we might actually see the NASDAQ, which is more oversold short-term on our money flows than the S&P index. And so we just might see on a relative basis a better performance from the NASDAQ. Now, does that mean the NASDAQ is going to go up? No. It means that the NASDAQ may perform better on a relative basis than the S&P. That it could also mean it just doesn't go down as much if we get into a bigger correctionary cycle in the markets. However, in the short term, I don't think that's going to happen. Again, money flows remain primarily positive. The sell signal here, very oversold. The same thing exists, of course, on the S&P to a little bit lesser degree, though. The S&P money flow indicator is still negative, and again, that continues to keep us contained within this sideways consolidation that we've talked about now for the last 3 weeks ad nauseum. But again, not ready yet to turn up here. But again, this indicator not as oversold as the NASDAQ. So this is why I'm saying we may see some relative performance improvement as money starts to look for a safer place to hide. Large cap, liquid names like Facebook, Apple, Amazon, Google, potentially we may see that, particularly if we start to see some more downward pressure in the S&P. This morning, we've got inflationary numbers coming out. This is going to potentially be an offset to the markets from yesterday, still putting some more pressure on some of the technology names on fear of higher inflation impacting the markets. We'll see what happens this morning. But again, just looking at kind of where we're positioning right now, those are things we're looking at. Now, look, if we also look at, for instance, areas like emerging markets, continues to be a good bit of pressure here, big underperformance relative to emerging markets, still on a money flow sell signal, not nearly as oversold as the other indexes. This suggests we've got more downside risk in emerging markets. International also continues to be on a buy signal here and performing, but still well within a consolidation. So again, there's a little bit better area here to put some money into on an international basis. But again, something I wouldn't chase too much right now. Small caps, which had a huge run from the lows last year, have actually petered out here. And again, on a sell signal, fairly fresh for a sell signal for a small cap stock, suggests more downside risk in the small cap space. So this is where I would probably start to avoid exposure. Small cap, emerging markets, kind of shift my focus back again to some of the larger cap, more liquid names where money's likely to hide, particularly if we do get into a bit more sloppiness later this summer. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.